Hello all and welcome back. So I guess we've all been having a pretty fun time in the stock market this year. I've actually liked the last few months. But we might be wondering, what do we do next? Can this keep on going? Can this really last? Where do we put our money now that we've made our runs in certain stocks and that sort of thing? Now, for my part, I don't think I've ever made this kind of money in the stock market. For the past like few months, I've been in nothing but Nvidia and Amazon and SMH, Mag 7. Everything that I've got is just going to the moon. It's already gone there. And so when you start a year, you think, okay, well maybe I'm going to make so much money by the end of the year. And for my part, I've already made all the money that I thought I was going to make for the entire year. I've already made it in the first month. And so I might be thinking, okay, maybe I'm going to go into something that's a lot less risky, just take all my winnings and then just maybe put it all into these 5.4%, US treasuries and just call it a year. But I can't find myself doing that. And the reason why I can't do that is because, well, I'm just kind of greedy. I'm gambly. I love doing this channel. And my gambling spirit just won't allow me to do it. And I love you guys. You guys are also gamblers and greedy, I imagine, too, or you wouldn't be checking out this channel because that's what this channel is all about. And so I'm pressing ahead for that reason. Now, here's one of the reasons that I know that you guys are greedy and gambly, and that's because last week I tried to be a little bit different, get something off my chest, something that I've been thinking about. Like it was a video on who's right, the Democrats or the Republicans, about the economy. And then nobody watched it. It was like the worst performing video I've ever had. I think I had like 20 views after a day. And then, of course, a few days later, Donald Trump comes out and takes credit for the entire economy. So it kind of put that debate to bed right there. And I thought it was funny because like the people that watch these videos, they don't care about red or blue. All they care about is green. And so, I totally respect that. And so this week, we're just going to be talking about what stocks to go into. I won't be bringing up stuff like about interest rates or the New York Community Bank, contagion effect and that sort of thing, and what the impact that might be on the stock market as a whole. What we're going to talk about is just stocks that I'm going to be thinking about going into and the research I've done, where I'm going to pivot next. If I'm going to pivot away from the Mag 7, even at all. So we've all made a ton of money, it's like, so, what do we do now? Well, to me, now it finally gets kind of fun, because up until now, it's just been ridiculously easy. A few months ago, I would actually lay in bed, and these are the things I think about. These are what goes through my head when I'm laying in bed. I'm thinking about, why would I buy anything other than Nvidia? It is so ridiculously underpriced. Why would I buy anything else, right? And these are the things that would run through my head. Well, now Nvidia's run a bit, so now there's some thinking that needs to go on. Why would I buy anything other than Mag 7 stocks at all? I mean, because they're the ones that are making all of the earnings, like all the earnings growth anyway, like 75% of all the net income for the entire S&P 500 is coming from those few stocks. And really, it's not Mag 7, really, it's just Mag 4. All of the growth, 75% of the net income is coming from just like 4 stocks. So why would I buy anything else? But that was then, and this is now, because, the way the market seems to work is first you get multiple expansion, and then your earnings have to catch up to this multiple expansion. It's the reason why companies like Microsoft and Google, they can report just out, hit it out of the park with their earnings and their revenue, but their stock won't go up that much because they had the multiple expansion, and now their earnings are just kind of catching up to that. And this multiple expansion earnings growth into the multiples is part of what, everybody says, oh, the market's ahead of itself. That's what this process is. It's the market getting ahead of itself. It's how we make money. We got to get ahead of the market. And so I've done some research, and I'm shown I'll look at some companies that I'm going to be looking to get into. Now, these aren't going to be very obvious, and they probably aren't going to make as much money as, in all likelihood, they're not going to make as much money as we have done here recently. But we're going to start off, we're going to look at some companies that have actually grown faster than Nvidia, like they've gone up more than Nvidia has over like the past year. And then after that, we're going to look into maybe like 4 stocks, maybe 5 stocks that I'm looking to get into. And I'm going to weigh the pros and cons of each, which one's more risky, which one's less risky, which one do I think is most likely to go up, or, it just depends on my risk tolerance at the time when I'm going to go ahead and buy these stocks. So let's go ahead and get in this video. So here's a list of the best performing stocks since the October low. And what you'll notice is that Nvidia is actually not number one on this list. It actually comes in at number seven. And here's the percent share price increase since the October low. And here's the upside and downside that analysts think that the stock has left in the tank. And we would see that the one that's advanced the furthest has been AMD, but analysts don't expect it to grow from here. They're expecting it to have a bit of a pullback. Builders First Source would be next, then United Rentals, then Uber, then Expedia, then Fifth Third. Finally, Nvidia shows up down here with a 54% stock price increase since the October lows, but people are only expecting 7.6% more increase out of this particular stock. Expedia, which we'll talk about later, is expected to go up 3.9%. I'm not going to talk about all of these stocks, but there are a couple that I'm interested in. Another one on the list would be Bath and Body Works, then Equifax, then Arista Networks. It looks like of all of them that have already run, the one that they expect to run the most still would be Fifth Third. That might be a bank. I haven't looked into that one. And the next one on the list would be Nvidia. Of the ones that have run really far, the ones they expect to see the largest pullback are going to be Arista Net, and they're going to be United Rentals. So this is a list that, just for your own, if you want to look up some of these things and kind of check it out. I'm going to talk about a few of these stocks on here, but this is something to go just kind of research a little bit yourself. So then Investor Place comes out and says, hey, let's look at 3 growth stocks to turn $100,000 into $1 million. And I thought this was a very interesting list because I am interested in the stocks on this list. And so number one on the list is Super Microcomputer. And the next on the list is Datadog. And the next on the list after that one is Palo Alto Networks. But before we kind of take these guys with more than just a grain of salt, let's see how they've done in the past. So here was their last article about turning $1,000 into $1 million. And this came out in September. This is as we were hitting our lows, we're coming into our October lows. And then they suggested that we run out and look at Bel Fuse, InterDigital, and JFrog. Now, using the S&P 500 as our baseline, over the past 6 months, we can see that the S&P 500 is up 10.73%. So of those three, the Bel Fuse, the InterDigital, and the JFrog, we want to see if they surpassed how much, and by how much did they go by 10.73%. So this Bel Fuse over the past 6 months actually grew at 35%. So Investor Place was correct. This one grew 3.5 times what the S&P grew. And then after that, you had InterDigital, and that one grew at 21.93%. So it doubled the S&P. And last but not least, you had JFrog, and that one over the past 6 months has gone up roughly almost double of the S&P. So they weren't wrong. So Investor Place does seem to have a little bit of credibility. So that's a good thing. So the 3 stocks we're going to look into now are going to be Super Microcomputer, Datadog, and Palo Alto Networks. Now, when you look at Super Micro, over the past month, it's up $290 a share, or it's up over 100%. So I would say that this one, we should look into this one. But a rise like this one would make me think that maybe it's some sort of like Wall Street bets, or like it has a GameStop kind of feel to it when you go up that much money in 1 month. And it does seem to be a pretty popular Reddit stock, but not in the way that GameStop was popular. It's more in a way of, why is this thing going up? Can anybody tell me what this stock is? So it is popular on Reddit, but not in the same way that was like, go diamond hands, let's to the moon, let's just take GameStop up. This one seems to have a little bit of substance to it. And the title of this article by Morningstar, who's of course very reputable, is that Supermicro is heading towards an Nvidia-like second half, but is it sustainable? This is the sort of thing that I was kind of asking. Yeah, it's up. What is it, one? And two, is it sustainable? The thing that Supermicro does is it's riding high on its ability to sell servers loaded with many of Nvidia's chips. There are other servers out there. They're made by, say, Dell or Lenovo or Hewlett Packard, but people seem to be high on the supermicro computer because it's selling Nvidia chips. Now, to me, this is less an endorsement for supermicro computer than it is an endorsement for Nvidia. But nevertheless, let's keep on looking at the supermicro. The question is even more applicable to Supermicro than Nvidia because by definition, the computer and server maker is in a commoditized business. Nvidia designs its own proprietary graphics processor chips that are in huge demand for AI applications, while servers to run them can be interchangeable. Like I said, there are other servers out there that the companies can use, but right now they seem to favor this Supermicro computer. Now, this is a company that is not going up for no reason at all. They just released earnings, and they showed that their second quarter revenue soared 103% over last year. So this run-up is justified, but can it last? He noted that Supermicro's fiscal second quarter revenue of $3.66 billion outpaced the company's full year revenue of $3.5 billion in all of fiscal 2021. This company is growing like crazy. In addition to looking at the past, it's also forecasting a lot more growth. Supermicro's guidance for its fiscal third quarter ending in March calls for revenue ranging from $3.7 billion to $4.1 billion. Again, this is one quarter of growth that's outpacing the last quarter and outpacing the entire year of 2021. So this growth is about 204% at the midpoint. For fiscal year 2024, Supermicro raised its revenue guidance to a range of $14.3 billion to $14.7 billion, and that's up 103% at the midpoint. They also talk about how their demand is stronger than what they can even supply. So I think we get it. So this is a server company. They run Nvidia GPUs, and because of AI, their product is in demand more so than say Cisco or Dell. And so let's go ahead and look and see what sort of valuation they have. And I know valuations are, you take it with a grain of salt. Really, there's only a few companies out there that you ever turn on the TV and they'll talk about valuations. Those companies would be Microsoft, Apple, Amazon, Nvidia, Facebook, Tesla, and Google. That's it. No, you will never hear them talk about the valuation of Nike, Starbucks, Costco, Eli Lilly, CrowdStrike, whatever. As a matter of fact, they'll come in, they'll complain that nobody cares about valuations anymore. And then 10 seconds later, they'll recommend you go out and buy CrowdStrike, which is, it blows my mind when I see somebody do something like that. So for right now, value investing, it's not dead, it's in hibernation. And so it's something that you should always kind of pay attention to. But for now, people are looking more at charts. Is it going up and to the right or not? But for the sake of valuation and the sake of comparing, say, SMCI to Nvidia or any of these stocks I'm about to mention in today's video, we're going to compare it to the valuation of Nvidia. So, similar to you would use the metric of the S&P 500 to other stocks. I'm going to use these stocks. I'm going to compare them to Nvidia and see if there's a reason to buy anything else other than Nvidia, or maybe, just for diversification purposes, maybe go into something else, who knows. But we're going to compare these stocks on this list to Nvidia valuation wise. And we're going to see that the price to earnings multiple of Nvidia is currently sitting at 87, forward PE of 53. It's really closer to about 45. But we're going to use Schwab's analysts data for this because we're going to use it for everything, all the other stocks on this list. We're going to look at their data, so we might as well compare apples to apples. So they have a forward PE of Nvidia of 53, indicating that it's a bit rich, and this happens to be one of the stocks that they will look at and look at the valuation of this particular stock. We can see that the short interest on this is very low at 1.1%. The growth forecast is 102%, and the net profit margin is 42%. So this is going to be what we're going to compare all other stocks in this category of, like, what's the next high riser to. We're going to compare them to Nvidia. So Supermicroconductor, they have a reasonable price to earnings ratio. They're actually cheaper than Nvidia is right now. Their price to earnings is 45 with a forward PE of 28. So this is a very fairly priced equity. Their growth forecast is 48%, so it's about half that of Nvidia. Their profit margin is 8%, so it's about fourth that of Nvidia, maybe even a fifth profit margin of Nvidia. The other thing is that they're very reliant on Nvidia, so that's something to consider when buying this one. It's cheaper, but it's cheaper for a reason. It's cheaper because it relies on Nvidia, and competitors not getting their hands on these GPUs. All right, so the next one on this list was Palo Alto Networks. Now, my favorite thing about Palo Alto Network is this chart. This is last 6 months. This is why analysts like it. It goes up and to the right. So when you look at it, I myself, I'm not very bullish on the cybersecurity sector in general because it reminds me a lot of, say, the payment sector. In payments you've got Toast and Clover and Apple Pay and Amazon Pay and Microsoft Visa. You've got Affirm, PayPal. Really, the list just goes on and on and on. And so these stocks were all red hot at one time, but they came crashing down. And I'm afraid that the cybersecurity might be in a similar boat. You got Palo Alto and Datadog and CyberArk and Juniper Network and Fortinet and Palo Alto Network, and you've got Zscaler, and you got Google and Microsoft have their own cloud security applications. And so it's very flooded. That's the point I'm trying to make here, is that it reminds me a lot of the payment sector, but these stocks go up and to the right. Valuations don't seem to matter except for on very few stocks. All they're doing is looking at these charts. So this is one that you might be able to get in and get out of. Now, of the cybersecurity stocks, Palo Alto is the one I like the best, because if you're going to get into it, you might as well get into one that's actually making money. So this one's got a price to earnings ratio of 195 with a forward PE of 62, indicating that it's got a lot of growth ahead of it. It does have some pretty fair amount of short interest, and understandably so. It's overvalued, and maybe there are analysts out there kind of waiting for that payment processing type of pullback that you had out of these stocks, but it's got a growth forecast of 22%. It's got a net profit margin of 8.5%. Now, let me go ahead, and actually it's the only one that's profitable of all of the cybersecurity stocks outside of maybe Fortinet. Fortinet is profitable because most of them would be like, say, Zscaler here. Zscaler has, you look at their price to earnings ratio, you can see that it's not yet profitable. It is expected to go profitable, but they say that every year, but it's not yet profitable. If you look at something like, say, CrowdStrike, which I mentioned earlier in this video, it also is very expensive because it's also not yet profitable, same as Zscaler, but they're expecting it to become profitable. But again, they've been saying this for years. And when it does go profitable, they say it's going to have a PE of 102 next year. So, but no one talks about this. Nobody cares. All they care is that these stocks go up and they go to the right. And so if you're going to get into one of these cybersecurity stocks, for me, it's going to be Palo Alto Networks, and I'll do it with the understanding that it could pull back in a big, fast hurry. Datadog was also on that list, and you'll see that Datadog is also not going to be profitable. But it's going to probably, they're going to say, hey, it can be profitable in the future, same as the others. It's the same with these every single year. I'm not sure they'll ever get profitable, but let's see, their growth is supposed to be 33%. Net profit margin is negative 1.7. All right, so that does it for the cybersecurity section of this. How about Expedia? Now, that's one that I was looking into, and one of the reasons I was looking into that one is because I think you can get some read-through in travel that will carry through to some of these other travel-related stocks. So if we look at United Airlines, its first quarter forecast was really, really good, and it actually beat top and bottom line. It had a top line of 13.363 billion versus expected 13.54. The earnings were $2 versus $1.69 expected. That to me blows away the expectations. Also, there was the forecast was very positive. If you look at American Airlines, we had the same exact thing. It surged 10% as strong demand drives a strong forecast. But they also had a strong quarter. They earned 29 cents a share versus 10 cents expected, and their revenue was another beat. And so I also started to wonder if all of this growth in revenue and earnings was just due completely to recreational travel, or was it more sustainable? I mean, is business travel also involved in this? I kind of thought that business travel is, one of these things where it's going to be declining with the invention of like Zoom and all that stuff. But it looks like with the back to office sort of thing, that business travel does seem to be on the uptick again. When we look here, global spending on business travel is expected to reach $1.5 trillion in 2024, exceeding pre-pandemic levels. You look at other articles seem to be saying the same thing, business travel volumes to outpace 2019 levels. And there's just one article after another just illustrating the same point. So these things made me kind of bullish on some of these other travel stocks that have yet to report earnings, companies like Expedia, companies like Airbnb. If you look at Expedia Group, they own hotels.com, VRBO, which I'm very bullish on, Travelocity, Hotwire, Orbitz, cheap tickets, car rentals, and the list goes on and on. Trivago, they got a lot of stuff. You can see that their price to earnings ratio is very reasonable at 27. I think that's what it said on that last page there, and that its forward PE is 15.69. If you do it in a conventional sense, you just have like what is the valuation of this stock. You would just take the current stock price, which was $150.50, and you divide that by the 15.69, which would be the forward PE, and we would say that that company makes $9.59 of earnings per share. And if you multiply that by a market multiple, say of 20, then we would say that we would expect in time when valuation does come back to the stock market that this stock could be worth $191 in the future. And that's when valuations do matter. Eventually they will matter, but right now they just don't. So the thing that we need to see here with Expedia is, will Expedia break through its level of resistance? If you look at Expedia over the past, say, I don't know, a year or so, it does seem like it gets stuck here at about the $150 range. But if their earnings come through really positive, I don't see it having a ceiling until it, starts getting a little stretched in its valuation around $190. So should it break through 150, it could be off to the races for Expedia. So this is one I'm definitely interested in. The other one I really like here is Airbnb. You can see that it has a price to earnings ratio of 17. Its forward PE is a little bit higher than its current PE, indicating that analysts aren't expecting growth from Airbnb over the next year. Now, I tend to think that it's expanding internationally. If you look at, like right here, I live in the United Kingdom. If you go over here and let's Google Airbnb, and if I look at, say, Airbnb here in Bury St. Edmunds, you could see that it's very active over here in Europe. And this is one of the things that I really like about Airbnb is that it's increasing its market share throughout the world. You can walk down the street, you go to any place down here and you say Airbnb, people know what that is. However, the same thing does apply to VRBO. As a matter of fact, I'd heard of VRBO out here before I'd ever heard of Airbnb out here. And so you can see you can get holiday rentals through VRBO. I've lived in England off and on for the past 30 years, and I did hear of this one before I'd actually ever heard of Airbnb. So I'm actually kind of bullish on both of these travel stocks right now because I think that the valuations are reasonable. I think they're growing because of their international presence. And I like the read through on the airline stocks and the positive outlook on the travel industry. And one last stock that I like, just as a bonus, I like Novartis here. And again, for the same reason that I kind of like other stocks on this list, when you look at this stock, it goes up and to the right. Now, what has Novartis got? Well, Novartis has this weight loss drug called Wegovy. And Wegovy would be similar to the Ozempic, the thing that's got Lilly on absolute fire right now. It's up to $667 a share. All people care about, again, is this thing goes up and to the right. I'm thinking that all they're going to care about is that Novartis goes up and to the right, and it also has a weight loss drug. Now, Eli Lilly is another one of those that, the valuations just don't matter on this stock. They're never going to talk about it. However, it does go up and to the right. And so its valuation of 15%. If you look at Novartis, it's actually on the same, actually, it's right next to it here. It apparently has no growth forecast, but it has a profit margin that's roughly 2.5 times that of Eli Lilly. So let's look at the price to earnings ratio of Novartis. Not that it matters, but the price earnings ratio is 42 with a forward PE of 35. So it's cheaper than Lilly. If it actually goes to say 120 multiple or whatever Lilly's at right now, you can expect this price to triple. Now, this is a European drug maker, so maybe it's not going to have quite the acceleration in its stock price as, say, Eli Lilly is, but it's on the New York Stock Exchange. Nobody seems to know that little fact, so maybe it could accelerate at a rate similar to that of Eli Lilly, given that they do have a weight loss drug, and should Wegovy catch the American conscious or the investor conscious, maybe this thing will shoot up in a straight line as well. That all remains to be seen, but it'd be something I'm kind of interested in. Now, I am having some bonds mature early next week, and plus I've got a lot of my Amazon winnings. I've sold a large portion of my Amazon holdings, and so I've got a lot of that money to play with too. So I'm going to be going into something, but I just don't know which way I'm going to go. It's probably whatever gets put to me. I'm going to be selling some puts on some of these things, and whatever gets put to me, that's what I'm going to end up with. So I would look at this as the most to least risky ratings and what I would be most comfortable versus least comfortable owning, and start at the most risky would be super micro. I think that one would be, it would have me looking at the market more than I need to when I get home from work. The next one would be Palo Alto Network. If I'm thinking if that's going to continue on the rise. Here's a cybersecurity stock I didn't actually mention, which is Sentinel One. It also is going up and to the right. It's about $27. So if you're looking to catch this wave, but you don't have the kind of money that it would take to get into something like Palo Alto, Sentinel One might be an equity that might interest you if you want to catch that wave up and to the right. Another one is going to be Nvidia. Obviously, to me, Nvidia is the obvious one. It's a really good chance I'll be owning Nvidia very soon, but we'll see how this one goes. And then Airbnb and Expedia. I already have a put sold on Expedia with a $150 strike, so I might be owning that one really soon. And the least risky on the list here, I think, is Novartis. Though you might not go up much, I don't think it's going to pull back much either. But I do think your risk reward is kind of more to the upside, because I think that people are going to start talking about that Wegovy drug. So now, does it seem that valuations, they don't matter right now? That's true. And are they ever going to matter again? Of course, they're going to matter again. But like I said, value investing is never truly dead, but it is hibernating right now. And I do believe that the first clue to valuations beginning to matter again is going to be when you see some of these high-flying cybersecurity stocks come crashing back down to earth, similar to the way you saw those payment processing stocks come crashing back down to earth. So watch for that happening. But until that happens, up and to the right is as good as any other indicator in the stock market about whether you should be buying something at this time. Well, except for the Mag 7 stocks, where the valuations actually do matter and they really do pay attention to it. But apart from those 7 stocks, up and to the right is good enough. But understand that the day is going to come where valuations will matter for the other 493 as well. It's just until then, there's some places where I think we can put money into the stock market and still have a little bit of fun. All right, well, I guess that's going to do it for this week. If you got anything out of this video, please like, subscribe, hit that little notification bell. Until next time, we will see you and have a great week. And I think the Super Bowl is next week. If not today, I'm not sure. Anyway, have a great day. Bye. So this past week, Heidi and I, we went into London a few times. And you can say what you will about London as far as like crime and congestion and that sort of thing are concerned. But I can tell you that there's always something fun that's happening there. And so we like to go in there, we do the fun thing, and then we just come back home to Barrie. And this is like basically what I would call our suburb, though we're about 60 or 70 miles away. Now, the first time we went there to see Depeche Mode over at the O2 Arena, and which I can could say that this O2 Arena, it's really improved over the years. I like the new mall area that they have there, and the sound quality in that arena is great. So I recommend anybody seeing a show over there now. And then the next time we went over there, we went down to Chinatown because we wanted to have dinner in Chinatown. And so we went there and we got dinner. But in this restaurant, we did find a very interesting sign on the bathroom door. And then we also went into North London to check out Tottenham Hotspurs. And Tottenham Hotspur that's my wife's preferred club. I tend to like Ipswich, but she really prefers Tottenham. So we both go to both games, which is fine by me because I really enjoy going to these Tottenham games. But when I looked over my videos that I took at this last Tottenham game, I noticed something. I noticed that I started this chant for the entire section. And I didn't notice that I started this chant until I went back and I looked over the videos. I watched it once, and then I had one of those Steve Urkel, did I do that moments? And I said, I did do that. Anyway, guys, have you ever been to a game and you started a chant for the whole entire section? Man, I have, but not until I had a couple of my sponsor this week, which is beer. I can't wait to go to the next game. And my sponsor again this week, once again, is Green King IPA. I can't seem to get enough of this. Brewed right here in Bury St. Edmunds, and I have to give this beer 5 Jumata Persecchis out of 5. Have a great week, everyone. Bye.